The Federal Reserve has about $2 trillion stored in the facility. This money could become a problem for banks if it isn't withdrawn soon. The Fed uses the overnight reverse repo agreement to take money out of the economy. This happens when banks or big money managers give the Fed cash in exchange for government bonds. The transactions in this agreement have been around $2 trillion per week and have increased recently. The Fed minutes say that more reverse repo facility usage is because there is less Treasury bill supply. People want to buy Treasury bills, but there are not as many as before. The reverse repo facility's interest rate is higher than the 1-month Treasury bill yield, so people are using the reverse repo facility more. Some of the biggest banks have to let deposits go to other banks. This is because they get many deposits, which can lead to lower returns on equity or smaller stock buybacks. So these deposits are not wanted, and the bank does not need to offer high rates. If the bank gets rid of certain non-core deposits, it can help the bank serve its customers better during tough times. However, for banks that don't have a lot of money or have a lot of fly-by-night institutional deposits, if people take their money out, it could force the bank to compete more quickly for deposits than they might have anticipated. By 2022, the banks at the bottom for deposit growth will have lost an average of 10% of their commercial deposits from the fourth quarter to the first quarter. The top quartile of banks, which provide data, technology, and analysis to financial institutions, will have seen a 2% rise during that same period. This shift will cause an increase in competition among banks. Banks that don't need to compete now might need to soon. Barclays strategist Joseph Abate thinks about $1.5 trillion worth of extra deposits at U.S. banks from the pandemic. Given the expected increase in interest rates and the Federal Reserve's reduction in its portfolio, Mr. Abate expects more competition for deposits to start happening next year. Morgan Stanley Bank analysts notice that people have been withdrawing their money from banks faster this year. This is happening as the economy grows and more people need loans. The analysts say that the rise in interest rates, quantitative tightening will worsen this. If banks don't raise their deposit rates or borrow more from capital markets, they will have to slow down the growth of their loans. Some reverse repo money may move back to banks as deposit rates rise. This will help relieve some of the pressure. The Fed could also change the terms of the reverse repo facility if needed. However, the current direction might serve a fundamental purpose. Bank of America notes that banks may increase lending rates to borrowers to offset rising deposit costs. The Fed may welcome these tighter lending conditions since it helps slow the economy down and would lean against inflation. That might be good news for people who worry about inflation. But bank investors have different concerns. Stay tuned with us and check back for more information by subscribing to this channel, and don't forget to turn on the bell notifications.